With AI dominating investing news, it's a good time to look at a sector not as prevalent in the media: industrials. From shipping to logistics to even space, the industrial sector has a diversified mix of companies on the cutting edge. These stocks are ranked based on the top performers from StockBoston.com. If more top performers have them in their winning portfolio, they are ranked higher. The SBU 100 measures the effectiveness of this strategy, and it's currently at an 85% APR right now. So you can be sure that these are stocks you should look into. At number 10, we have Star Bulk Carriers. Star Bulk Carriers is a buy because it has modernized its dry bulk fleet while maintaining a conservative balance sheet. Its Q2 revenue was $454 million, which topped estimates, and its earnings per share was about 35 cents, which beat estimates by 3 cents. With another dividend paid this quarter, it marks 10 straight years of dividend payouts. Management has a $100 million vessel sale plan to dispose of older, less efficient tonnage, and it's going to streamline the fleet and bolster liquidity, hopefully. In September 2024, Star Bulk sold a Cape-size vessel named the Star Triumph at a gross price of $20 million, and this netted them about $13 million after debt repayment. With a $1.5 billion book value and $400 million in liquidity, Star Bulk Carriers looks like it might be able to continue to grow in value, but still give you a good dividend. At number 9, we have Performance Shipping. Performance Shipping owns the larger sized tanker ships that carry oil and other liquid fuels around the world. Right now, these kinds of tankers are in short supply, so companies are paying a lot of money to rent them. They just added a brand new eco-friendly tanker, and this ship meets these very strict pollution rules, so bigger clients are preferring to rent them. They also have a 5-year deal at $31,000 per day for this type of ship. That means they'll get nearly $11 million per year on just this one ship, and this can really help them plan their spending because of the guaranteed income. Because Performance Shipping has newer, cleaner ships and locked in high daily rates, its profit and EBITDA should grow steadily. That makes Performance Shipping a buy for investors who want a more reliable income and hopefully the chance for the stock to rise. At number 8, we have 3M. 3M is a company that makes a lot of different products. Think Post-it notes, Scotch tape, and then we get into other crazy stuff like electric cars and computer chips. They do the special materials for these electric cars and computer chips. They can earn money in so many different ways with so many different products. So if one area slows down, other areas keep growing. This diversified portfolio of products helps to consistently pay a 3.6% dividend. Recently, the US and China agreed to lower tariffs on some goods that really affect 3M. This tariff drop was about 10%, and because of that change, 3M now thinks it can make $7.75 a share, which is up from the $7.60 per share. 3M works with consortiums to invent stronger, lighter materials for electric vehicles and computer chips, and this really keeps them ahead when new tech takes off. All these points, diversified products, reliable dividends, lower cost, cutting-edge tech, and upside potential really makes 3M a strong buy for long-term investors. At number 7, we have Amprius Technologies. Amprius Technologies is a buy due to its breakthrough silicon anode batteries, delivering up to 50% more energy density than graphite cells. A $15 million contract with Nordic Wing for drone endurance boosts revenue visibility, and Asian contract manufacturing capacity now exceeds 2 gigawatts. As demand for next-gen EV and defense batteries accelerate, Amprius Technologies is well positioned to lead the pack. Before we continue, we kindly ask, we really want your stock ideas. Share your ideas and even just your hunches at StockBossip.com or on the StockBossip app. If you share good ideas, we'll showcase your ideas on our platform, our newsletter, and videos like these. Sharing an idea takes 30 seconds at StockBossip.com. At number 6, we have Rocket Lab. Rocket Lab is a leader in small satellite launches, leveraging Electron's record 70th flight and the upcoming HASTE mission for NASA. Electron is Rocket Lab's own small satellite launch vehicle. It's a 2-stage rocket designed to carry lighter payloads, typically up to 300 kilograms, into low Earth orbit. shares just hit a 52-week high at $54.03, up 10% as portfolios shift into space infrastructure names. From a little personal experience, I will say I was very disappointed with Astra. They were trying to do the same thing and they didn't really accomplish it, and it looks like Rocket Lab will do it. There is a huge market for small satellite launches. We are doing a ton of satellite launches all the time as a human race. But, it's really hard to get all that technology going, and it looks like Rocket Lab has figured it out now. At number 5, we have Lockheed Martin. Lockheed Martin is a great buy for new investors due to its resilient defense franchise, high-margin missile and aerospace systems, and a 2.8% dividend yield. Lockheed Martin just reported Q4 earnings per share of $7.29, beating estimates by 72 cents, and revenue of $18.16 billion, nearly missing the $18.59 billion consensus. Lockheed Martin's 21x forward PE sits at a discount to its peers, making Lockheed a solid defense exposure at a fair price. At number 4, we have Boeing. Boeing has a very deep backlog consisting of defense contracts and a recovering 737 MAX program. After an emergency landing in Japan triggered a minor share pullback, Boeing's fundamentals remain intact. Over 34% revenue growth and a surprise beat on Q2 earnings per share. Multiple firms, including Vertical Research, just upgraded Boeing to a buy with a $270 target. Currently, it's at $216, making the shares trading 20% below that consensus, offering meaningful upside when supply chain and safety checks clear. At number 3, we have Symbotic. Symbotic is the backbone of automated warehousing, capturing 26% revenue growth last quarter. Symbotic's AI-driven robotics systems slash labor costs and accelerate fulfillment, giving retailers a competitive edge. Shares jumped 3.7% on news of a 25.9% year-over-year revenue gain, though Q2 earnings per share missed by just 8 cents. With a $28 billion market cap and 481,000 shares trading, institutional upgrades to neutral and buy ratings suggest the stock is primed for a sustained rally as e-commerce grows. At number 2, we have Caterpillar. Caterpillar has an unrivaled equipment business. Even in a softer construction cycle, Caterpillar's diversified revenue mix and cost controls deliver industry-leading margins. Analysts have trimmed Q3 earnings per share estimates to $4.56, but they lifted next year's full-year earnings per share forecast to $21.02, reflecting improving end market signals. Before we get to number 1, we just want to ask one more question. If you like getting really good stock ideas that came from only the best of thousands of investors, then we would love it if you liked and subscribed so that more people can get this good information. Because at number 1, we have Virgin Galactic. Virgin Galactic is one of the few pure-play space tourism stocks with growing institutional interest. Call option volume spiked over 230%, signaling big bets that Virgin Galactic will resume its post-dip rally. The latest Q2 earnings beat estimates by 65 cents, and management plans Delta-class ship tests ahead of full service in early 2026. With a low market cap and a pipeline of private astronaut bookings, Virgin Galactic is poised to soar once flights resume. Well, thanks for watching. If you want to see even more great stock ideas, check out Stock Bossip. No other platform gives trusted investment insight like Stock Bossip because we do things different. We only showcase ideas from consistently good investors.